Awesome. So thanks everyone for joining. Welcome. My name is Jason Grillo with Air Miners, and it's a pleasure to welcome you to our event on insurance to unlock carbon removal. Before we get started, I wanted to talk a little bit about Air Miners for those of you who might be new to us. We are an organization that's dedicated to the vision of restoring the environment, restoring the climate. And the way we do that is to remove the first billion tons of carbon dioxide equivalent from the atmosphere by the end of 2030. That's our mission statement. That's what we get up in the morning dedicated to achieve in our Air Miners organization. And that we do that through a variety of ways. One is through our community. Another is through our Launchpad program, and just talk a little bit about that. That's an accelerator program for very early stage startups. Think, just 1 or 2 or 3 people, just a handful of folks on their way to removing large quantities of carbon from the atmosphere, carbon equivalent from the atmosphere by the end of 2030. Shared a link with you all for any of you who are startups who want to join. We have our deadline of February 10th to apply to our next quarterly 6-week accelerator program. The other thing that we do, a lot of our events like this, and to that end, we have an outstanding panel of people talking about insurance. This came about because the insurance function is something that is starting to get a lot more attention in carbon removal. How do we figure out how to insure these long-lived assets that are going to be, and credits that are going to be produced by all the itty-bitty startups right now that are going to grow into larger companies in the future? How insurance can unlock that, can make that future possible, something we're going to dive into shortly. How we do for the run of show today, we'll have our panel discussion for maybe 35-40 minutes, followed by Q&A. Feel free to put your questions into the Zoom chat. I'll monitor that, and then if you are available, can ask you to ask your question if we have time before the end. We'll do the Q&A for 15 minutes, and I'll come on at the tail end for a couple of announcements, and then we'll be out. At the top of the hour, we'll stop the recording and then go into our networking session afterwards. You don't have to stay if you don't want to. We're all busy, understood, but we find this way as a good method of getting to know each other, not just know of each other. We'll do Zoom breakout rooms for the folks who want to hang around, chit chat, learn about what other people are up to, and then go from there and comment about what we just heard. It's being recorded today, so it'll be on our YouTube channel in a couple of days, and you can view it there if you want to replay or share with others. With that, I wanted to say thank you again for coming, and I'm going to hand to our moderator, Charlie Sidoti from Insurer. Charlie.
Thank you very much, Jason. Thank you for putting this on. This is a great topic and a great turnout. You do a great job. We're super excited to work with Air Miners. I'm going to do a quick introduction to myself, and then I'm going to turn it over to the panelists to introduce themselves. As Jason said, I'm Charlie Sidoti from Insure. Insure is a nonprofit. Our mission is to foster innovation in insurance. And we really focus on 3 kind of impact pillars, which are closing the protection gap, accelerating the transition to a low carbon economy, incentivizing resilience, and promoting nature positive practices, all through the development of new and better insurance products and services. With that, I'll turn it over to Natalia next to introduce herself, and Kita.
Hi everyone. Thanks for coming. My name is Natalia Dorfman. I'm the CEO and co-founder of Kita. Kita is a insurance startup, and we are focused on insuring carbon. So our first product is just released, and we're insuring carbon delivery risk. But the goal of Kita is really, just like we're going to be talking about today, how do we use insurance to de-risk carbon removal solutions to enable more uptime financing, to enable all of you to go out and scale your businesses at the speed we all need to fight climate change. So that is our mission. The goal is to develop a portfolio of products, but the first one is for that carbon delivery risk.
Excellent. Next, I'll turn it over to Ted.
Thanks, Charlie, and thanks, Jason, for hosting us today. Great to be here. My name's Ted Christie-Miller. I'm head of carbon removal at BeZero Carbon. I lead a research, ratings, and partnerships team for the engineered carbon removal side of the market. For those that might not be familiar with BeZero, we are a global carbon ratings agency. So picture it similarly to how S&P and Moody's function in financial markets. We function in a similar way in the voluntary carbon market. My background is in the policy world, so I founded and led the climate program at the think tank Onward in Westminster, where I did a number of different pieces of research on future tech innovation and industrial decarbonisation, and that's how I sort of migrated into this CDR world and joined BeZero nearly a year and a half ago.
Excellent. And last but certainly not least, Mischa, please introduce yourself.
Thanks, Charlie. Thanks, Jason. Great to be here. I'm calling in from Zurich, Europe, so it's rather late. I almost missed the call because I was bringing my kids to bed and fell asleep myself, which usually happens. I work with Swiss Re, global reinsurer, one of the biggest. I'm there in the group sustainability team. I just lost the title as risk manager because I changed team and am now more worried about the general sustainability strategy of the company rather than just checking for sustainability risks. Before I was in operations, I was designing the net zero strategy for operations there, and now just released last week at the WEF the Net Zero Insurance Alliance target setting protocol version 1 that I was leading. And by background, I'm a scientist, so I have a PhD in process engineering, but did environmental sciences and studies. I worked in carbon markets before joining Swiss Re, and I'm going to a rotation now, doing underwriting, real underwriting for the next 6 months. So afterwards, I can tell you really something about insurance. Now you just have to bear with me.
Nice, thank you so much. This is a fantastic panel. I'm honored to be moderating it. Before I jumped into the questions, we read a lot of the pre-questions that came in. There was a huge range from some basic insurance questions to some extremely specific questions. And we're certainly not going to be able to cover everything in 35 minutes. Jason's going to be sharing all our emails, and some of us will probably stick around afterwards. And before I jump into the first question, I wanted to just give a little bit of a baseline of just the basic insurance 101. Insurance is a contract, usually between 2, sometimes between 3 parties, and it's a promise to pay if something goes wrong, and typically related to some sort of specifically identified risk. And it's important to understand that, and that kind of basic structure of insurance. We will be talking about some of the elements of how it applies both generally and specifically to the topic of carbon dioxide removal. And with that in mind, Mischa, I'm going to kind of ask you. You've got that kind of scientific background. You've worked at Swiss Re. You've done a lot of work studying the risks that might trigger some sort of event that would potentially pay. Could you just kind of walk through some of the common risks that would be potentially faced in the sector, and
Sure.
differentiate between some of the like normal risks and some that are really kind of specific to the function?
Yeah, of course. And the good news is most of the risks that we can imagine and think about, model, contemplate, and get our heads around related to CDR are pretty common. So we can insure a lot of things in this value chain, and not a lot looks novel or is really something that we wouldn't like to touch. However, a couple of things are novel, and these are usually also the ones who are seen as, who could really bring a breakthrough in terms of supporting scaling up, supporting deployment, supporting trust in markets and so forth. But let's start with the easy thing. So if I'm an insurer and the Swiss Re Institute, our internal university, published a knowledge piece. It's called the Insurance Rationale for Carbon Removal Solutions. And in there, we are thinking about the value chain, and we've split it between nature-based solutions or natural climate solutions and the technological ones, just a bifurcation, because they're fundamentally different. In the CDR value chain, we have capture steps, we have processing steps, we have transport steps, and then storage ultimately. And we put that in a flow scheme, and added for all the different steps related to nature-based capture, processing, transport, storage, related to technological or engineering capture, processing, transport, and storage. What are analogs? And we found quite a lot. Take a direct air capture unit. You have chemical plants, you have refineries. So that looks pretty alike. It's machinery, it's equipment. And an underwriter who is usually doing engineering or just property or casualty for such industrial facilities should feel pretty familiar with the direct air capture unit that is essentially just a chemical engineering plant of some sort. So we've put some analogs behind all the blocks and little icons to show, hey, there is a lot of green stuff, green, amber, red. Green we can insure right away. We know how to do agriculture insurance when it's about regenerative agriculture and nature-based solutions. We know, for example, credit and surety insurance types when construction materials come into place, where CO2 is stored in construction materials. So there's really a lot we can do. Transport, another example. We have marine lines of business. Maybe a bit of a novelty there, or not so much novel. In the US, you have 5,000 miles of CO2 pipelines already, but the pipeline question, the shipping question of CO2, that's a bit novel. So the hulls are needed to be redesigned. But also there, we don't see a lot of showstoppers. So in all these steps along the two value chains for nature-based solutions, technological solutions, we have property damage covers, we have property business interruption covers that we can do, we have classical casualty, and that includes short-term environmental liabilities. And so even, if CO2 bubbles up from a reservoir, for example, and causes some damage to aquifers, that would be that type of environmental liability that one can in theory cover and try to understand. I mentioned credit and surety already. Political risk insurance can be mentioned if you have nature-based solutions in emerging markets, for example. That could play an important role. Engineering covers for sure. The transport-related ones, marine cargo, but also offshore installations are under marine. And then comes the big novelty here, which is the long-term liability, or some call it climate liability. And this is essentially looking at the risk of storage reversal events. And that can happen in all, endpoints of the CDR value chain, no matter if that is nature-based or engineered, if this is geological storage, or if it's just a forest that's supposed to be there forever. This is the novelty here. And the reason why this feels so uncomfortable, it has never been such a topic. So there is essentially, nobody has put CO2 somewhere just to put it there, treat it as a waste and try to seal it off as well as possible. A couple of CCS projects in relation to point source capture, not too many. That's then pretty much it. And when always you have a lack of a loss history, when you don't know a technology well, when you don't know the behavior of CO2 in the underground well enough that can look back 50 years, what loss events can occur, so accidents can occur, then, well, our models are lost, right? We cannot feed that data in the premium, in the pricing models. The actuaries, those who calculate the models behind insurance contracts, don't know how to deal with that. And, the classical reaction from a big reinsurer would then be, or big insurer, reinsurance and insurance would be, oh, hands off. Rather not be out there first and wait. Because as soon as you're the first out, you're going to collect the first losses. That's a very different world compared to investments. If you believe in where you invest, then you want to be on top of the wave and ride it all the way, because the others will follow. In insurance, if you can believe as much as you want in some new novel technology, if you're at the top of the wave and you don't know it well, you're going to collect the first losses. Those who come after you, they know what to exclude. They know the first losses. So they're much smarter than you, and they will do more profitable underwriting. So that's the difference. Bottom line, we can insure a lot of things in that value chain. A lot of things are very classical things. And there is a big new thing, which is the long-term view. How do we protect essentially stored carbon via insurance tools? Great. And you can go deeper there, but I make a pause.
Great answer. Thank you, Mischa. Ted, can you talk a little bit about the, Mischa talked about all the different risks that are faced. Can you talk about the role of rating agencies specific to the carbon, the storage reversal, but also just how does your rating agency and rating agencies in general promote transparency and around the quality of carbon credits?
Yeah, thanks, Charlie. Yes, it might be worth just doing a bit of, I don't know how familiar people are, a bit of a sort of background of what the BeZero carbon rating is and what we do. So we're a carbon ratings agency. We have a platform which provides all of our research and analytics that underlie and accompany the rating. So the BeZero carbon rating, really, it provides users with a risk-based assessment for understanding and interrogating carbon credit performance. We do it of any type, in any sector, country. It's across the whole voluntary carbon market. And the credit rating represents basically our current opinion on the likelihood that a given credit achieves a ton of CO2 avoided, CO2 equivalent avoided or removed. And so the rating itself, it follows a robust analytical framework that involves detailed assessment of 6 critical risk factors that sort of touches on something that Mischa was talking about there on the non-permanence risk, but we also look at additionality, over-crediting, leakage, policy, and perverse incentives. And we've got a team now, I think it's constantly growing, but I think of about sort of 25 environmental and carbon scientists that undertake these ratings. And then we've also got a growing team of Earth observation scientists, about sort of 15 of them, that use sort of satellite imagery to have that extra layer of analysis. And we've got a sort of 4-stage process that undertakes to do that rating. So we've got a macro factor assessment, project-specific assessment, risk factor weighting, and then we have our internal committee review of those judgments. So on the topic of the transparency point, really, I suppose for me, it is really integral to the growth of this market. And we try and reinforce that by having quite strict criteria around public methodologies. So we only use publicly available data for our ratings. We have, as far as I know, one of the first of its kinds accounting template that we published that we really think that the market is best to fix around. We also have strict criteria around third-party verification of LCAs and strict criteria around additionality testing. And with all of that, I think I see us having sort of 2 key functions in the market that you sort of touched on there, Charlie. So the first is as I said, boosting transparency. So, the current market for engineered carbon removal functioning within that wider voluntary carbon market ecosystem at the moment has our unstandardized reporting and disclosure requirements. And without transparency in an illiquid market, it's very difficult for buyers to develop trust in the projects they're supporting. You too often have credits that are being sold which are untraceable, have low levels of data to back them up. And so in order to determine whether a carbon credit really does represent the climate impact it claims, the market needs to be able to see some detail, really. So that detail that we look for is things like baseline assumptions, project emissions, issuances and retirements, and more that you can see on our website with our public data template. And I think without this kind of transparency that we're really asking from project developers and from exchanges and intermediaries, that narrative of this Wild West carbon market that has so often been spun for the wider voluntary carbon market, I think there's a real danger that creeps into this new and emerging CDR market. So I think that transparency point is key. And I think we really it's one of our key campaigns is to try and push transparency in the market. Firstly, because it's just crucial to boosting trust, but also it means that we are then able to undertake the ratings to help that market. And then second, I think there's a point here that we're bringing to it, which is fixing what I see is just the key market failure in the wider voluntary carbon market, but this is also present when you're looking at just CDR, which is the lack of correlation between price and quality. Like, you can't have a sustainable growth in a market where there is no price discovery or risk allocation. And so what we really see ratings as being integral to that. And in time, I hope to see that credit price will start to correlate alongside BeZero carbon rating. It's, we only published the first suite of ratings sort of under a year ago. So we're still sort of waiting to see that data and how that's come through in the long run. But I think that trying to fix that problem is going to be crucial if we pull off what we're trying to pull off. So yeah, I'll leave it there. But overall, really, it's ratings, I think, are crucial to help that transparency and trust issue and help the price discovery point.
Awesome. Thank you so much. Natalia, Ted talked about the transparency and quality from the ratings perspective. The insurance kind of steps it up a notch and provides that promise to pay that I talk about, which is the essential piece that insurance does. Can you talk about how a specific insurance product can support that transparency and quality, and also maybe talk a little bit about how you evaluate that risk in terms of your underwriting process or underwriting processes across similar kind of products?
Yeah, of course. And I suppose at a high level, I think just what you said, insurance is unique in this space. And I'll say the voluntary carbon market, obviously widely, right? Yeah. Is unique in that it's the one participant that holds the risk. Everyone else, to some extent, can sort of keep passing the risk to someone else. And at the end of the day, the insurance company, if they agree to insure this project and there is a claim, they are sitting there holding the risk. And so I think that is a very powerful message to the market, that insurer is willing to actually bet on this project to the extent that if they get it wrong, they pay. I think beyond that, I do think insurance is an indicator of quality in many ways, but I think at the top level, insurance is an indicator of risk, which sometimes is aligned directly to quality and sometimes is not. Right. And so I'd say we, for example, with BeZero, we speak to Ted and his team a lot because insurance ties very well into ratings. But what we are assessing with our first insurance product, at least, is the risk that this underlying project that we're insuring will not deliver the carbon that it is promised. So to some extent, that can be disassociated from quality, because let's say it is a brand new startup doing a novel form of CDR in a historically high risk country. That is a high risk carbon removal project that we might not be able to insure or might come with a very high insurance price. It doesn't necessarily mean it's a low quality project. It might be an amazing project. And so I think there is a point there with insurance that we are assessing the risk of a specific risk that we are quantifying. And so I guess we sometimes are conscious of not causing unintended consequences in the market. But likewise, I do think in this market where buyers are faced with a lot of challenges in terms of what do I buy? Is it nature-based? Is it engineered? Is it this standard? Is it that standard? The indication of a risk factor, and a risk factor that influences the pricing, in essence, of that carbon, is a really powerful thing because it gives them an additional tool by which to decide. And I suppose our insurance, I'm happy to talk through the rate, sort of how we assess the risk. But going back to what Mischa said, we'll say there are many different types of insurance. And I know we're going to come on to this later in the session. There's many different types of insurance which could be provided in this market. So ours is just one, but ours is assessing the delivery risk of the underlying project. And so the way that we assess this delivery risk is in a way not unlike how Ted and the team assess the risks from their end. But we're looking at what is the likelihood that this project will be able to actually deliver the amount of carbon credits that they forecast they could deliver. So we look at things like track record of the project developer. We look at things like their credit score. We look at the contract that they're using and the clauses within that contract that provide safety to both the seller and the buyer. We look at the standard and methodology that's being used, which again is very important to us and a challenge within the CDR space. We look at the country risk, where is this project located? And there's aspects of political risk within that, but there's also broader country risk factors. For example, are there grant schemes, skilled employees, tax incentives that support this industry, or there are things that could be headwinds that could slow it down in that particular country. And then, of course, we look at the technical risk of the underlying project itself. And, forestry is a very easy one here to look at. And I know probably none of you are in the forestry space, but, it's very easy to get some data to show if you plant these trees in this location, what is the likelihood that they're going to grow to 10 years, let alone 100 years. So we do, of course, look at the technical risk of the underlying project. But that's just our insurance. And we plan to, and I know others are looking at developing other types that would assess other types of risk factors.
Great. Natalia, you mentioned earlier that you work often with Ted's BeZero. Could you talk a little bit of, and maybe Ted too, if you add to it, like how these two tools, the ratings and the insurance, work together to kind of enable the unlocking of the industry, the growth of the industry, essentially?
I can give it a go, I suppose,
Yeah.
and there's multiple ways we can do it. I mean, we're both new, and so starting out, and we'll be figuring it out as we go along. I suppose the ideal is that we get to the stage where it's like a Moody's and an S&P working with a credit insurer, and we can really just rely off of their ratings and use it as a reasonably easy tool to be able to assess in essence, creditworthiness of the underlying project. I think right now the data that we're assessing is still slightly different, and that delivery risk is slightly different than some of the aspects they're looking at. But I think we can coalesce it over time. I think one powerful thing we can do together, which I think would be relevant for many of you on this call, is actually with the newer CDR types that are still trying to figure out MRV and the methodologies, et cetera, we can tell you what data we both need to see in order to give you a rating and to give you insurance. And I think there's potential for us to be able to provide that kind of outline of, as you set up your business and you start to grow your business and you start to track your data, et cetera, we need to see these things. And if you're able to show us these things, then when you're ready, we'll be able to give you that rating and give you that insurance. And we've spoken a bit about that already. And I think the ability to do that could be a great accelerator for many of the younger companies coming up that maybe aren't at the stage yet where they're really selling or really looking for significant financing, but need to be starting out, I guess, best foot forward from the start. I don't know, Ted, further comments, of course, or contradictions on that or will.
No, I think you hit a nail on the head there. I mean, I see it as if we both try and pull off what we're trying to pull off, you can envisage a scenario where the current big insurers that use credit ratings from S&P and Moody's and Fitch, for instance, that same relationship can work, and then the two really would sort of work in lockstep with each other. So ratings in the voluntary carbon market will allow insurers, I think, to understand that carbon efficacy of a carbon credit. And like when insuring a bond, for instance, it'll allow them to help calculate that risk. So I think there's a really strong potential to have a similar mission and to work together to drive that data transparency point. But the one thing I think that Natalia sort of touched on a bit there, that's the sort of third pillar of sort of integrity in the market, I think, is that MRV point. And I think without sort of MRV ratings and insurance, I think only with those can you start to sort of build the trust and integrity in the market that is necessary for it to scale to the level we need.
That's awesome. Mischa, you hear about the innovation that Kita's doing and BeZero's doing. Can you give a little bit of your perspective on the innovation, what other innovation you're seeing from the Swiss Re perspective, and also some of the challenges and opportunities and where you think kind of the innovation roadmap is going for the sector?
Well, I have a good story and a bad story. The bad story is we are one of the most conservative industries that you can imagine. Okay, it's really hard to excite us. So it needs a Kita, it needs a Natalia to say, okay, I'm doing insure tech. I go out, I do something small, and then I try to place that capacity with some globals. But that a major insurer moves and is really innovating and testing, this is very rare, and it happens in the background often. So sandboxing is a key word here. put some, you dedicate some capacity to some novelty and see what's happening with it, but you don't make a fuss about it, right? Because you never know where this is going. So it's hard for me to talk innovation here. There is an idea that I would like to share later, nevertheless, which is probably the good side of the story. And I just want to defend our industry for a second before going there. You have to understand that it's really, you know, if take the buffer pool example, that's a good starting point. The buffer pool seems like a brilliant insurance solution. And I explain it quickly. So you have a project that creates 100 credits. Then you have some questionnaire that says, are you at risk of leakage, of reversal? Is it politically stable where you do your project? And, you know, 1%, 2%, 3%, 5%, depending on how many clicks you have, the more percent goes into buffer pool, say up to 20%. So 20 credits go in a buffer pool, they sit idle. And if there should be something happening to your project down the line, then this buffer pool can be, you know, called and credits from that buffer pool can be retired. And the problem here is that the developer doesn't really have an interest 10 years later, if something happened to your project, take a forest and it burned down, to tell the buyer from back then, it could be, you know, the predecessor of the predecessor of the predecessor of some CSR job in some company who bought those credits once, to tell them, hey, your forest burned down, you have to do something here and we retire those credits on your behalf. As mentioned, the guy who bought it 10 years ago has zero interest because he moved on and is gone, right? And companies usually, so far at least, did not track their purchases. They simply purchased them, then put a claim based on that, right? And the claim stands then there in the CSR report of that year. And there it goes. Nobody looks for it afterwards. We're not stewards of our credits, not stewards of our claims from every year. And then these buffer pools start growing. That's one thing that can happen to a buffer pool. It grows, grows, grows. Take the big standards. Their buffer pools are pretty sizable because nobody ever wants to tap into them. Or the buffer pool is way too short and you have a couple of projects centered around the west of the US and there's 1, 2, 3 big fire seasons and boom, the whole thing went into the air and it's falling way short because the buffer pool should still hold for the next 100 years. This is a very bad insurance solution, right? And it is that bad because it's not easy to do that insurance. It's not easy to, think 100 years ahead and, figuring out, what's the risk of reversal 100 years ahead of something that has not been done in the past. And frankly, research hasn't been too much interested and so on and so forth. So topic of CCS has been around, but it was always, being pushed a bit to the corner from any side. It's too expensive or it's too mitigation deterrence or it's too whatever, right? Not under my backyard. So when I was thinking innovation of this last piece, that is the really difficult thing, how to ensure that the carbon stays down there, what role can insurance play? I'm trying to get the product. I talked to Natalia. I think that's the best place to start with. I talked to my own underwriters, not sure whether this is going to happen. So I started to share that. I'm waiting for it to happen. I think stored carbon should be treated as a property, just as a property that is at risk of an accident. This is something an underwriter understands very well. Every year we do renewals. So we do we check the risk and we see what's happening, how much is that property at risk, and we do the pricing accordingly. And if you want to have a like-for-like mechanism that the payout is not in cash, but in terms of a new equivalent credit, carbon credit, or at least as much cash that you can afford an equivalent credit at the current market price, you have to predict the market price a year ahead, but not 50 years ahead. And then it says, I can never estimate how the carbon price, that market evolves. So that's nothing for me to insure in a casualty way, an accident way. But every year, if you can do a property reassessment and the repricing, taking the risk that this carbon is at risk of being released, plus the current market price into account, you come up with a number that you can then go back to your purchaser, the buyer, and tell him, so the credit that you purchased 10 years ago, together with the insurance cover that this carbon stays stored, here is the new premium for year 11. And the buyer can think, okay, do I want to pay that premium, or do I want to abandon that credit and replace it myself with a new one to back this claim that I did 10 years ago? So that would be for me a real innovation if you start thinking that way. And I think with buyers becoming more and more quality savvy, it's actually an avenue that we should test. Somebody should go and test that. Do we find buyers who are willing to do that? Of course, the premium should be a small share, depending on how much that is as risk. But adding over time, it should also lead to some equivalation of the different quality or say durability types in that sense. So a geological storage credit is probably insurable with a very small premium compared to the volume or the initial cost of the credit. Nature-based solutions, a forest credit, is probably a much bigger share of the cheap price that you paid initially, but over time it accumulates. So if you do a 100 years calculation, you end up at a very similar price point. And then you can think, do I want to support the forest project or the geological storage project? So this, I just throw that into the room in order to spark discussion. Not tested it. I didn't find the underwriters to do it, but I would be really glad to see that in some years materializing and being tested. And Natalia was happy to continue the discussion. So I hope product 3, 4 would be that one.
Super.
Yeah, I've heard other people mention the same thing, so that is very open to continuing that discussion.
Natalia, do you have anything to add, or just to what Mischa said, but also just what you see in the innovation roadmap over the next 1, 3, 5 years? Yeah,
of course. I think I'll echo what Mischa said. I think I am a huge supporter of the insurance industry. I think it gets a really bad rap, actually. I think it does a lot of amazing, amazing things, and particularly in the climate space. It's obviously an industry that is very, very exposed to climate change. And it does a lot to build resilience and create those safety nets for people. I do think, though, because these tend to be very, very large companies, very, very regulated companies, they do tend to move slowly on innovation. And again, like Mischa said, you have that kind of first mover loses sort of thing where you try first, you get most claims. And so they tend to do things sort of in smaller sandboxes. And also, what is a big market for Kita is a tiny, tiny, tiny market for a company like Swiss Re. And so you have to assess, is the time and the effort spent to figure out how to insure this market, is it worth it? I do think, though, what the insurance industry does very well is work with startups. And so they have mechanisms in place for companies like Kita to come into the market more quickly, things called being a managing general agent or a cover holder. But what that in essence means is we develop insurance, we sell insurance, but we don't hold regulated capital. So we are backed by larger insurance companies who in essence underwrite us. And so, for example, we announced today we're working with some big insurance companies, Chaucer, Renaissance Re, Munich Re, sorry, Mischa. So those larger insurance companies, I think, have actually been incredibly innovative in the approach and willingness to work with us. And therefore, I think startups have a huge role to play in this market in being willing to, as people have said to me, you're willing to put your head above the parapet and sort of make a big noise about what you're doing. And when you do that, you also run the risk of an embarrassing failure. But I think for Kita, the reason we started the company is because we think insurance is essential to accelerate the growth of carbon removal via driving more finance to it. And that is our mission, and that is just very wholeheartedly what we're trying to do. And we recognize we won't get everything right, but as a startup with venture capital backing and these larger insurance companies backing us, we have the power to do that. So I do think startups have a huge role. I think then in terms of the innovations that we've seen, there are insurance products available on the market. You have Parhelion has been on the market for ages in the compliance market, but moving into the voluntary market with an invalidation product, now supported by Howden, an insurance broker looking at this a lot, as well as I think backed by Nephila. I saw Chris Slater on the call, another startup looking at this space. I've spoken to other people looking at, how do you look at cyber risk even? What if Vera, et cetera, gets hacked? So there are innovations coming out onto the market, I do think slowly. And I would say one of the big challenges here is the carbon markets move very, very, very quickly. insurance moves very, very, very slowly. So we need to be building insurance that's actually able to evolve with the times, so to speak. And I think that will be another challenge for the industry, is how do we create products that are able to shift and evolve as the needs and the players in the voluntary market shift. But it is happening. I would expect in a couple of years' time there'll be a lot more products to pick from.
That's great. We promised Jason that we would leave 15 to 20 minutes for some Q&A, but I will just reference Mischa, the document that Mischa referenced earlier in the conversation. Everybody should absolutely read that document. It's fantastic. And I think Jason will share it with the crowd at some point. Yep. With that, we'll open it for questions. And Jason, I'll let you kind of say how we're gonna kind of take the questions. Are we? Sure.
I've been contacting a few people who've asked questions. By the way, we will have too many questions to be addressed in the scant time we have left. So that's why I shared the speaker emails. If we don't have the time to get to your inquiry, feel free to reach out to any of the people we've been having the discussion with today. So thank you all for that. Next, first person I want to talk to is or hear from would be Chad Ralston. Chad, are you here and able to unmute? If so, do so and ask away.
Yeah, I'm here. Can you hear me?
Yep.
Please.
All right. Yeah, I was just curious how CDR purchasers currently are assessing whether the projects they invested in have underperformed or performed as expected. Are they kind of relying on ratings agencies like BeZero or self-reporting by the project developers, or is there some other mechanism?
Jason, do you want me to jump in on that?
Please go ahead.
Yeah, so I think it depends what you're saying by CDR, I suppose. I think in the sort of afforestation and NBS space, we rate a number of different of those projects on our platform, and they are the ones that have the ex-post credits on the market. There's a little bit of biochar out there, but most of the ones that we all talk about, your direct air captures, your enhanced weatherings, ocean alkalinity enhancement, all of these methods, we're really talking about future credits. And I don't think there's any. I think most of the assessment that's being done by buyers is either through a consultancy that's doing a deep dive, or it's sort of fairly informal, and it's not quite like these aren't credits that you're using against offset strategies, right? They're kind of future promises of a ton. So it's not quite the same as having an ex-post credit. So I think there's a rambling answer, but the short answer is I think for the NBS side of things, rating agencies definitely are being used increasingly so. But for that engineered CDR side of things, I think there's a number of different things people are looking at.
Okay, great.
Chad, if I may add, just keep in mind that it's also, I don't necessarily need to know how a project performs as a buyer, as long as I just say I do result-based payments. So I wait until a credit is here and then I pay it. I don't care if it was underperforming project or overperforming project. So this is in a full-fledged VCM in a carbon market with many different developers offering the same thing. If a carbon credit, a CDR credit becomes something fungible, it's not so much a question anymore. You just take what's on the market, and what hasn't made it on the market, you don't care that it wasn't there because you took something else.
Great.
But for an investor, of course, it's something completely different. The investor really wants the project that the investor invested in to deliver 100%, maybe 120. So completely different story. And they would definitely go to Natalia.
Yeah. Speaking of delivering, so Nate Wyne, apologies for getting you. Wyne, sorry about that. Good question about an article that's certainly been making the rounds in carbon markets as of last week, the Guardian article. Nate, feel free to go ahead and ask.
Yeah, my question was focused on, in the wake of the article, so I'm a startup and we sell into a lot of asset managers. A lot of them are asking what steps should we take now in the wake of articles that poke, a 90% hole in what's considered the most, I think, a legitimized offset scheme in the world. If they're saying 90% of those credits are false, what do we see asset managers doing to make sure they're not buying a bogus narrative?
So there was a rebuttal on that article as well. Huh? So
oh yeah, Will posted it.
we should share that too.
We have an academic on our team who read through the initial, and at least the initial pounce by The Guardian was very academically founded. It was peer reviewed over 9 months, multiple stops at flagship spots that they had tried to approach. So I'm anxious to read the rebuttal, but it wasn't hey, we're kind of mad at you. It was, this is false and you can't keep doing this, was the tenor of the article. So I'm curious from the panel, especially those of you who worked at the larger organizations, how do you take this and how do you see a way forward if this is kind of the, the gold standard becomes almost a joke?
Mischa, go ahead, Natalia.
Oh no, I'm happy. I'm sure any of us can answer this in our own way. I was going to answer it in a, I suppose not exactly addressing the article itself, but more around, I think the question of how should an asset manager, who's worried about this, how should they start looking at it? And I'll go beyond Kita. Prior to Kita, I worked at law firms for about 15 years. And I'm not a lawyer, but I worked with the clients at law firms. And in my last law firm, I led the strategy for the firm's climate risk practice. So we spoke with a lot of the regulations and the litigation and the liabilities coming out of this climate change for large corporates. And so I suppose I think about it from the perspective of law and how we would have advised clients at a high level, where you'd be saying, okay, let's look at your fiduciary obligation here, right? Based on the market today, you know that you need to buy these credits, right? To address your carbon, footprint in the world, you need to be buying some high quality carbon offsets. So how do we look at your fiduciary obligation to do that in the best way possible in today's current environment? And so I would use a high quality carbon broker, who can help me to assess the risks if I don't have an in-house team to do that myself. I would be looking at a Silvera or BeZero, probably both, to give me that external viewpoint and assess the average of their ratings on that project. I would definitely be looking at an insurance company, to provide me an additional indication of risk and is this project insurable or not. But in essence, I would be thinking about if I got dragged into court in 5 years' time or 10 years' time, what am I going to say? Can I legitimately say that today, based on the information available to me, I did everything I possibly could to buy the highest quality carbon credits with the information I have today? And then that I address that information on an annual basis each year to make sure that I continue to buy the most high quality available. And if I found out that the past quality was not up to par, I replaced it. And I think to some extent that is all you can do, because it is a challenging point. But I'm sure Ted and Mischa probably have. I didn't address a lot of the challenges in that article. It was just a very long potential other conversation. But that would be from the sort of legal perspective, I would be doing those aspects to just do the best that I could today.
No, very good answer, Natalia. You can also watch the John Oliver weekly show on carbon offsets. Okay, that's a more entertaining than the Guardian article, and says the same. And it's not the first time that this is uncovered. The CDM, the official Kyoto carbon baseline credit scheme, also there 85% is the estimate, the academic estimate of hot air. And it's remarkable, right, that we have this situation and still people have a race to the bottom attitude and, have a volume that they want to compensate, and then they go for the cheapest. And what is the cheapest? Usually there must be something wrong, because you cannot afford there are a lot of articles who tell you that you shouldn't pay $5 per ton for even for letting a forest be a forest and then do 100 years of monitoring. Does that cover, $5 per ton? Impossible. I think what really helps here is, as Natalia just described, do your due diligence as a quality savvy buyer, and that should not happen. And maybe accept that you are not going to afford, if you have a certain finite budget, that you're not going to cover 100% of whatsoever you want to compensate, but take that budget and deploy it in the most meaningful way, even if that's $100 per ton also for a forest credit. That's a change of attitude that should happen, and then we are very well protected against such reputational risks and damage. Swiss Re as a buyer, for example, we're very reluctant to go for natural climate solutions as of yet. We're really waiting for standards, for good examples for credible things in the market that we can start trusting. So it's just anecdotally a sign of how cautious we are in engaging there. But I'm hopeful. I mean, there is a lot of guidance coming out, procurement guides and things like that. And I generally, buyers become more quality savvy for sure.
Well said by both of you.
Yeah.
Thanks.
Thanks. Great. Natalie, you have a question about who's responsible for shouldering the risk. Could you unmute and ask?
Yeah, sure. Around the topic of risk of reversal, I'm curious, like thus far, who we've seen be financially responsible for shouldering the insurance cost, right? Associated with protecting risk of reversal. Is it the buyer of the credit? Is it the project developer? And I'm also just curious, have you seen this particular type of insurance becoming more common, especially with nature-based solutions that are, have higher risk of reversal?
Yeah, Mischa, I'm happy. You can take this one, or I can.
Yeah, I think so. Take CCS. CCS at some point was, and Europe is a good example, was at the point where the regulators said, you developer, you need to go and buy and find insurance if you want to do geological storage of CO2. And there were some financial obligations that were built in, and the regulator said, this is what you need to cover, protect yourself against. The developer looked around and said, well, nobody offers me this, because the insurance market said, for sure, I'm not going to do that because I have no idea what you're doing. And then it was a stall, it was a Mexican standoff, and the insurer was pointing to the regulator, you have too high regulations. The regulator said, you developer are responsible. We don't do public things with insurance together. So this was this triangle, and nothing happened for years. And this is something that we have to break now. And frankly, I'm not seeing it as of yet, right? So certainly we don't have a mandate, a regulatory mandate to do these things. We're talking voluntary carbon market still, but there are these movements that, an EU is designing a scheme for CDR. So I think this is also, give it some time, but we're not moving as fast as possible. Insurance would really like to turn to the regulator and the public to say, okay, how can we do that together? To what extent can we go and cover a risk? And at what point can we do transfer of liabilities? When are you comfortable enough? When has the developer demonstrated solid, rigorous enough monitoring or performance of the project? So it's a discussion that we can have, but it usually stopped there, right? Therefore, I brought in this idea of treating that stuff as a usual property cover. It's just a different angle of looking at things.
Great. We only have a few minutes left. Grant, feel free to unmute and ask your question. That'll be the last one, and then we'll have some concluding moments.
Okay, thanks. Yeah, and thank you all very much for the great panel. The question I wanted to ask relates to technical risk. This came up when Natalia, when you were talking, when you were responding to one of the questions. I was curious how, if it isn't proprietary, how insurers accurately assess technical risk of new technologies, things that have never been deployed before, first of a kind projects. And if there is a unique way in which you're doing that, if that might have some kind of like cross applicability to investing in these technologies, either from the part of an investor or a government funder or anyone else who's trying to scale up these technologies.
I would say there's no key to secret to this. Assessing any new technology is hard. We've built this insurance to be as scalable as we can across the different forms of CDR. And then we did that via weighting it. So across, we have, 7 different risk factors. And we've weighted it towards those that are less technical, make it an insurance lingo look most like a credit insurance policy, or sort of a default on a contract, coupled with a bit of a performance type product. But it's not a fully technical risk. So it's not a, the machinery combusts. Well, actually, that's not true. Let's stick with forest. Let's say a technical forest is the easiest to understand. So there's a fire, but then they're supposed to replant and the carbon might grow back. We're still at the end. We pay out at the verification point. We don't pay out at that sort of initial port of loss, if that makes sense, or a default on the contract at the point at which the carbon is supposed to be delivered. So we've structured it in a way where we thought we made it less technical based. But that said, this is one of the, Ted and I have talked about this a lot, but one of the challenges with the more novel CDR solutions is you sort of need them to get to a point where there's a group of them that are in the same kind of category, then we can figure out how to insure that technical risk. So a biochar, an enhanced weathering, a DAC, there's becoming more of them in that category that we can figure it out, versus if it's an entirely new novel solution. Constructing an insurance product specifically for, in essence, that one-off right now is still challenging, even for anyone. Does that might be a too high level, but that's our thought process on it.
I think that makes sense. Yeah, it's hard.
Great, thank you. Last quick hit question. Just we have really not that much time left. How can entrepreneurs in the audience engage with each of your organizations, including Charlie, for that matter? Just 1 or 2 sentences, really fast.
We work with startups and corporates. We have this kind of connect, learn, solve strategy to connect people often across traditional boundaries, including from clean tech to insure tech. So reach out if you're trying to solve a problem. A lot of times we can connect you with somebody in our ecosystem. You can reach me at charlie@insure2ns.org.
Already shared. So great. Natalia, Mischa, Ted.
Yeah, I'd say the same. We really like engaging with the market and understanding what people want, what people need, where the challenges are. So definitely reach out. I'd say I personally might be a bit backlogged right now because we just did a big announcement on Kita today, but we will get back to you. It might take a little bit of time this week.
I just posted the link to the Net Zero Insurance Alliance target setting protocol. There is a target type, number 5 in there, that's called reinsuring the transition. And this is the opportunity side of things. So I would go 29 members, NZIA, big insurers, knock their doors, even if it's via the switchboard, and tell them, well, you have target type number 5. Here is a climate solution. Can we work together? So that's cool. And if you do that with Swiss Re, this helps a lot, okay? So, because only if there is questioning from brokers, from developers, from whoever asking for insurance, the industry will move.
Great. And Ted, please bring us home.
So I suppose if you're a CDR developer, please do reach out, LinkedIn or email. You've got my email now, and we can discuss how ratings could work. If you're interested in the ratings and the research, follow us. Get in touch if you want to become a subscriber to the platform as well. Just want to flag, tomorrow we're publishing a first of its kind scalability assessment for different carbon removal methods. And so we're going to be doing a public summary report and then the full analytical report on the platform, but keep an eye out for that if you're interested.
Awesomeness. Thank you all. And thank you to our audience for being here. I've shared some links with you. First is our post-event survey. If we did a good job, if we didn't do a good job, we'd like to know about that so we can make our events better for next time. To that end, we have 2 events coming up, one on how we sold our first carbon credits, another one on how we raised our first $500,000, featuring some air miners companies who can share their stories about how they undertook those endeavors. Next, got some other links for joining our community, and also, speaking of the Launchpad, to again apply to our Launchpad program. Until then, we look forward to engaging with you in any and all aspects of carbon removal. And I just want to say once again, thank you for coming, and thank you to Charlie for moderating. Thank you to Natalia, Ted, and Mischa for being such wonderful speakers on an event that I feel like moved the ball forward a bit on carbon removal today. So thank you all.